Save or invest first? Here's the right answer. Imagine you finally have some extra money at the end of the month. Maybe it's $200, $500, or even $1,000. You have two choices staring at you. Should you put that money into savings, or should you invest it and give it a chance to grow? At first, the answer seems simple. Saving feels safe. Investing feels exciting. But choosing the wrong one at the wrong time can create serious financial problems. So, which should come first? The answer is not simply save or invest. The right answer is save first, then invest strategically. But there's an important reason why, and understanding it can completely change the way you manage money. The problem with investing too early. Let's say you have $5,000 sitting in your bank account. You decide to invest all of it because you want your money to grow. 6 months later, your car breaks down, your income suddenly drops, or you face an unexpected medical or family expense. Now you need $2,000 immediately. What happens? If you don't have emergency savings, you may be forced to sell your investments at exactly the wrong moment. And this is where many people misunderstand investing. Investing is designed for money you can afford to leave alone. The stock market, bonds, ETFs, real estate, and other investments can fluctuate. Sometimes your investment rises quickly, sometimes it falls dramatically. If you are forced to withdraw during a downturn, a temporary loss can become a permanent one. That's why your first financial priority should usually be building a financial safety net. Step 1. Build your emergency fund. Think of your emergency fund as financial shock absorbers. You hope you never need them, but when something unexpected happens, they protect you from a much bigger crash. A common target is around 3 to 6 months of essential living expenses. For example, if your essential monthly expenses are $2,000, an emergency fund of $6,000 to $12,000 could provide a meaningful buffer. But the exact number depends on your situation. If your income is highly stable, you may need less. If you're self-employed, run a small business, work on commission, or have unpredictable income, you may want a larger reserve. And remember, an emergency fund is not designed to make you rich. Its job is to keep you from becoming financially desperate. That distinction is incredibly important. But what if savings earn very little? Here comes the argument investors often make. Why keep thousands of dollars in cash when inflation is reducing its purchasing power? That's a fair question. Cash sitting idle for decades may lose purchasing power over time, but your emergency fund has a different purpose. You're not holding it primarily for maximum returns. You're buying security, liquidity, and flexibility. Imagine your investments earn 8% over the long term, but the market suddenly falls 25% when you lose your job. Would you rather have cash available or be forced to sell investments after a major decline? The emergency fund gives you something incredibly valuable: time. Time to find another job, time to recover, time to make decisions without panic. And financial freedom is not only about how much money you make, it's also about how many bad decisions you can avoid when life becomes unpredictable. Step 2. Deal with high-interest debt. Now we reach another critical question. What if you have savings but also have expensive credit card debt? This changes the equation. Suppose a credit card charges you 20% or more in annual interest. Trying to earn 7% or 8% from an investment while paying 20% interest on debt is usually a losing battle. Why? Because the debt cost is guaranteed, while investment returns are uncertain. Paying down expensive debt can therefore function like earning a guaranteed return equal to the interest you avoid. This doesn't mean every debt must be eliminated before investing. Low-interest debt, such as certain mortgages or other relatively inexpensive loans, may require a different strategy. The key is to understand the interest rate, risk, cash flow, and opportunity cost.
Step 3. Then start investing. Once you have an emergency fund and controlled high-interest debt, investing becomes much more powerful. Now your investment money has a job: long-term growth. This is where compound growth enters the story. Imagine you invest $500 every month. You don't need to become a millionaire overnight. You simply need to give your money enough time. Your contributions create growth. That growth can generate additional growth. Then that growth begins producing even more growth. This is the snowball effect of compounding. And here is the most important part. Time can be more powerful than trying to perfectly predict the market. Someone who starts investing consistently at age 25 may have a tremendous advantage over someone who waits until age 40, even if the second person eventually invests much larger amounts. The lesson is simple. Don't wait for the perfect moment. Build the foundation, then start. So, should you save and invest at the same time? Absolutely. Personal finance is not always a sequence where you finish one step and completely ignore the others. You can save and invest simultaneously. For example, imagine you have $1,000 available each month. You might allocate part toward your emergency fund and another portion toward long-term investing depending on how strong your financial foundation already is. If you have no emergency savings, you may prioritize cash. Once your emergency fund is complete, more of that monthly amount can move toward investments. The allocation evolves as your financial situation improves. This is why personal finance should be viewed as a system, not a single decision. What about people who want to invest everything? You may hear someone say, "Cash is trash, put every dollar to work." It sounds sophisticated, but it ignores one fundamental reality. Money has different jobs. Your rent money has a different job from your retirement money. Your emergency fund has a different job from your vacation fund. Your business capital has a different job from your long-term investment portfolio. The mistake is treating all money as if it has the same purpose. Money you need next month should generally not be treated the same way as money you won't need for 20 years. The shorter your time horizon, the more important stability and liquidity become. The longer your time horizon, the more room you generally have to tolerate investment volatility. The three-bucket strategy. One simple way to think about this is with three financial buckets. Bucket 1, safety. This is your emergency fund and short-term cash. Its purpose is protection. Bucket 2, goals. This is money for medium-term objectives, such as buying a car, starting a business, paying for education, or making a major purchase. Its investment strategy should reflect when you expect to need the money. Bucket 3, growth. This is long-term investment money. Retirement savings, diversified portfolios, and other long-term assets belong here. Its purpose is to build wealth over many years. When you separate these purposes, financial decisions become much easier. The real answer. So, should you save or invest first? If you have no emergency fund and significant high-interest debt, focus on financial stability first. If you have a reasonable emergency fund, manageable debt, and stable cash flow, you can confidently increase your investments. And if your emergency savings are already complete, keeping excessive amounts of money in cash may prevent you from achieving your long-term growth goals. The real objective isn't choosing between saving and investing. It is knowing how much money should be saved, how much should be invested, and what each dollar is supposed to accomplish. Saving protects your present, investing builds your future, and financial freedom requires both. Because the wealthiest person isn't necessarily the one who gets the highest investment return. Sometimes it's the person who built enough financial stability that they never had to sell their investments in a crisis. So before asking, "Where can I get the highest return?" ask a better question. What job does this money need to do? Once you know the answer, the decision between saving and investing becomes much clearer. And that's the real secret to building wealth. Not simply making money grow, but making sure your money is working for the right purpose at the right time with the right level of risk.